Markets don't just move, they reveal us. When prices plunge, something primitive in the brain flips from plan to panic. Decisions that looked rational in calm times, sell the loss, move to cash, time the bottom, suddenly feel urgent, necessary, even heroic. But here's the cold truth. The greatest, most consistent wealth destroyer is not bad markets, it's emotional investing. Behavioral science shows that humans are hardwired to avoid losses harder than we pursue gains. That bias alone explains why panic selling during crashes is mystically common and tragically profitable for those who remain calm. Prospect theory, the bedrock finding in behavioral economics, demonstrates that losses hurt about twice as much as equivalent gains feel good, and that asymmetry drives irrational choices in crises. This episode will do three things: unmask the reflex that makes crashes feel like calamity, expose the proven errors investors make when fear mounts, and give you a battle-tested toolkit to stop losing money to your own instincts. Let's begin. The invisible hand of panic. What happens in a crash? Market crashes don't just erase numbers, they hijack your nervous system. Two forces collide in a crash: fight or flight biology. The same systems that helped our ancestors survive predators now push you to act immediately when you see red. Market social proof. We watch others sell and feel compelled to follow. Herd behavior. That combination explains the classic destructive reflex: sell low. History gives us an ugly pattern. During the March 2020 COVID collapse, institutional managers sold large positions and net selling pressure spiked, while many retail investors actually bought into the dips. But what dominated headlines was panic. Funds experienced elevated outflows and open-ended fund redemptions that stressed liquidity and created procyclical selling. These flows intensified the volatility and turned a market shock into a cascade. Here are the facts that matter when you feel panic in your chest. Bear markets, falls of 20% plus, historically last around 9 to 15 months, with an average duration close to 11 months. But recoveries to prior peaks typically take longer, often approximately 2.5 years to get back to the old high. That gap between the nadir and full recovery is where many investors panic and lock in losses. Over long horizons, stocks have historically rewarded patience. The S&P 500's long-run average annual return is roughly approximately 10%, meaning long-term holding drastically changes the math versus short-term reactions. That's why knee-jerk selling and trying to time the exact bottom is statistically poor policy. Decode your brain. How cognitive biases derail you. You don't need to be irrational to act irrationally in a crash. These predictable mental shortcuts do the work for you. Loss aversion. Losses feel heavier than gains, so you'll overreact to declines and underreact to recoveries. Herd mentality / social proof. We copy crowd exits because it feels safer to follow the group than to stand alone. Empirical research from 2020 shows attention spikes and selling pressure are correlated with worse returns. Confirmation bias. Once you suspect the market is doomed, you'll filter news to find evidence that confirms the fear. Action bias. The illusion of control pushes people to do something instead of following a plan. Doing something during a crash tends to lock in losses. Understanding these biases is the first practical defense, because once you can name the enemy, you can design systems that neuter it. Building your emotional fortitude toolkit. Defenses that work. You can't eliminate emotions, but you can design around them. Here are robust, evidence-based tools that stop panic from costing you money. 1. Premeditated calm. Write the storm plan today. Decide before volatility arrives what you'll do if the market drops 10%, 20%, or 40%. A simple plan might say, at minus 10%, no action. At negative 20%, review asset allocation. Rebalance only if long-term targets are skewed greater than 5 percentage points. At minus 40%, consider opportunistic buys if fundamentals unchanged. Pre-committing removes the cognitive load when emotions spike. Write it, timestamp it, and treat it as sacred. 2. Automate and forget. Automation neutralizes action bias. 2 automation levers matter. Automated contributions, weekly or monthly, which dollar cost average into positions without you deciding each day. Automatic rebalancing using your advisor or platform, which sells winners and buys laggards mechanically, forcing discipline. Vanguard's research comparing dollar cost averaging, DCA, and lump sum notes DCA's behavioral advantages. While lump sum historically outperforms roughly 2/3 of the time, DCA helps avoid bad timing and is emotionally easier for many investors. The technical takeaway: DCA is a behavioral tool. not necessarily mathematically superior, that helps prevent paralysis. 3. Use fractional shares and micro positions. Fractional shares let you invest exact dollars into expensive names and maintain diversification even with small balances. That means you can keep exposure without worrying about all-or-nothing decisions that fuel panic. 4. Rebalance. Don't react. Rebalancing is not capitulation. It is systematic buying low and selling high. Use a rules-based rebalance, annual or threshold-based, rather than emotional fixes. Historically, rebalancing improves risk-adjusted returns for many portfolios. 5. Focus on probabilities, not certainties. Long-run data shows that over multi-year windows, most rolling 5- and 10-year periods produce positive returns. Capital wealth. Advisors' analysis and similar studies show that 5-year windows are positive far more often than negative, which means that a crash is likely a temporary disruption, not a permanent loss of retirement savings. Use that probability edge to quiet fear. The Strategic Investor's Blueprint. Tactical checklist. If you want a one-page playbook to post on the fridge, here it is. Emergency liquidity. Hold 3 to 6 months of cash separate from your market portfolio. This prevents panic selling to cover living costs. Predefined allocation and tolerance. Write your target mix and maximum tolerable drawdown. Automate contributions, weekly or monthly transfers to investments. Set rebalancing rules, annually or at plus or minus 5% drift. Use tax-managed harvesting. Capture losses where sensible to offset gains. Limit news intake. Check once daily, not continuously. Avoid sensational headlines that trigger action bias. Mindfulness routine. A 3-minute breathing check before any trade reduces impulsive decisions dramatically. Neuroscience shows short conscious breathing breaks lower, amygdala-driven responses. Common mistakes to avoid and what to do instead. Mistake: panicking and selling at the bottom. Do instead: pause, check your plan, review fundamentals. Mistake: trying to time the market bottom. Do instead: use DCA or invest lump sums when disciplined. And remember, lump sum historically outperforms often, but only if you can hold. If you can't emotionally hold, DCA is superior for behavior. Mistake: overtrading based on headlines. Do instead: reduce news volume. Set a daily 10-minute window for market checks. How calm investors win when markets collapse. By now, one truth should be clear. Market crashes don't destroy wealth. Emotional reactions do. Every crash rewrites the leaderboard, not because fundamentals suddenly changed, but because discipline disappears. The calm don't just survive downturns, they harvest them. Let's move from psychology to execution. The long game. Why time, not timing, builds wealth. One of the most dangerous myths in investing is the belief that you must get out before losses deepen and get back in at the right moment. The data says otherwise. Multiple long-term market studies show that missing just the 10 best market days over a 20-year period can reduce total returns by more than 50%. The brutal irony? Those best days often occur during or immediately after crashes, when fear is at its peak and investors are sitting in cash. This creates a deadly feedback loop. Panic arrow selling, sitting out during volatility, missing recovery days, locking in permanent underperformance. Timing the market requires being right twice. Long-term investing only requires patience once. Rebalancing. During crashes, the counterintuitive advantage. Rebalancing feels wrong in a crash, and that's exactly why it works. When equities fall sharply, stock allocations shrink. Bonds or cash grow as a percentage. Risk drifts lower than your long-term plan. Rebalancing forces you to buy what's cheap and sell what's expensive, automatically. Historical portfolio simulations consistently show that periodic rebalancing improves risk-adjusted returns. It reduces volatility over time. It turns emotional market swings into systematic opportunity. Think of rebalancing as emotional outsourcing. You remove decision-making at the exact moment your brain is least reliable. If you want to understand how money really works, how psychology shapes markets, and how to build wealth without falling into the same traps, subscribe to Finance Facts. We don't chase hype. We decode behavior. We help you think clearly when it matters most. Because in investing, the strongest asset isn't money, it's discipline.